Markets are markets, and obviously responding to facts. The way we look at things right now is that there's lots of things that are going on in the noise category, and lots of actually quite good things that are going on in the real category. Trade is still flowing. Goods are flowing. The U.S. economy is strong. The South Asian economies are strong. China printed a 5% GDP number last year. Not a disaster. We know that there are issues. Trade flows are open for the most part. So the things that drive economic growth, I mean, the prospect of productivity coming from new technology tools, AI, et cetera, are encouraging. So the real economy is doing quite well. Yeah. And there's a lot of noise. Now, obviously, if the noise starts to translate into impact on real economy, we could have and obviously there's a little bit of a reaction today in that regard, but from pretty comfortable levels, right?
Bill, I hear what you're saying, and it's incontrovertible about what you're saying about trade and China, and I get that. But there are so many seeds being sown, whether it be increased tariffs, which are still there, even if they're a lot less than people thought they were going to be on April 2nd. There are geopolitical uncertainties. There are concerns about the medium-term trajectory of the dollar, about US bond markets, about debt trajectories that aren't not in the noise category and aren't in the here and now good category. They are in the seeds sown for potential problems further down the line.
So obviously we're navigating through a new geopolitical environment, and obviously with escalating rhetoric on all sorts of fronts. We know that. We also know that the rhetoric has not translated over the past couple of years into things that have had a very material economic impact. And the market is obviously hopeful that will continue to be the case. I'm also hopeful that will continue to be the case. If it's not the case, then we're going to respond. Right? Yeah. Then we're going to react. Markets could adjust, but at the same time, people are then going to start to accelerate the reconfiguring of their supply chains, to accelerate the way that they enter into different types of trade agreements. Like, there's been a lot of free trade agreements signed this year, at the same time as there's been a lot of tariff.
Sure, yeah, but they've all been pretty asymmetric as well. Let's be brutally honest.
No, the free trade agreements. I'm talking about Europe and Latin America. I'm talking about India and the UK.
But you mentioned a changing geopolitical environment. It's not actually a lot of the same old rivalries or same allegiances. They're all the same. What we're really talking about, without beating the bush, is actually we've got an administration which is upsetting the post-war, the Bretton Woods setup for the global economy. That is not changing geoeconomics. That is one person and one administration upsetting the entire apple cart.
That's true. And back in the days when the U.S. was 35% of global GDP, that kind of a change of course would have a very profound impact. The U.S. is now less than 50% of global GDP. Very, very big, right? So the U.S. is very big. Well less than 50% of GDP. The rest of the world is catching up quickly. And economic power is more distributed than it has been at any time probably in human history. And that in and of itself is a helpful thing for diffusing some of this tension.
Bill, let me get into some of the nuances here. So last year, as the world debated all the uncertainty, we saw a president laser focused on trade deals, correcting imbalances as he saw it. We also saw a president that was reaching for peace wherever he could find it. This year feels quite different, where he's not afraid to swoop into a country, cause partial regime change, and whether that's about security or resources to further America's interests. And we are seeing now that this is a president who is willing to entwine trade and foreign policy, and whether that does pose a challenge to the NATO alliance. If these risks are real in 2026, what does that mean for the movement of assets, the consequence for holding US dollars, US treasuries, where there's more diversification in assets? How do you think about that if we are looking at a real story here? I
think markets are looking at, as you commented right up front, they're looking at how all this stuff affects economics and how it affects business, trade flows, and money flows and the like. And so far, these actions, they have not had any impact on the real economy. And there seems to be, I think the markets are giving the U.S. administration and others, I think, Chinese as well, some credence to the idea that they have an eye on the economy at the same time as they are trying to reshape geopolitical dynamics in a particular way. And until that changes, I don't think the markets are going to get terribly concerned. But I think your point is, are we going to push the boundaries? And is there going to be some volatility? Yeah, I'm pretty sure we've had volatility and we're going to have volatility. But we know that we've had a pretty quick reversion to mean in terms of trend lines, both for interest rates. I mean, 4.28 in the 10-year. This 10-year has really not moved very much in the past 3 years. It's been between 4 and 4.30 for the most part, right? And equity markets obviously are still at levels that represent pretty close to the highs.